precipitation hypothesis, preferred habitat, segmentation, and you guys are awesome. Okay. And if the Federal Reserve buys bonds, bond prices go up and interest rates go down. Got it. And when they sell bonds, bond prices go down and interest rates go up. Awesome. And then when the yield curve inverts, the S&P 500 peaks within 12 months, and we're in a recession within 20 months. Got it. And then did we go through the table? We did. Is that the next thing we were going to do? Is that where we left off? So I would start, scratching for the numbers. The Dow, oil prices, gold prices, 10-year Treasury yield, and then dollar to the pound, dollar to the euro. Okay, I'll set up the table. So for this, where it says economic indicators and targets, that's where we want to do the table. Okay? And the table is going to be like this. This is the table you want to write down. Okay, so it's going to be asset class. And then it's going to be value or price. Got it. And it's going to be either up or down. And then, how much. And then it's going to be y. Basically, what we're looking for. We're talking about the 5 major asset classes: stocks, oil, gold, bonds, and U.S. dollar against foreign currency. So where's the Dow Jones? Where did it settle today? About, looks like 3 hours ago. Where did the Dow Jones Industrial Average settle? Where did it close at? You gotta look it up. Click. Yahoo, www.yahoo.com, Yahoo Finance, click. And then boom, right along the top. So you guys gotta be looking.
You want the number?
Yeah.
26,949.
26,949.
0.99.
0.99?
Yeah. So
26,900.
49.9.
Okay, I don't need that. Okay. Over the last week or two, up or down? Is it trending up or trending down? Trending up. Got it. And then over the last week or two, can you calculate the number of points or percentage change? Is it up 250 points, 500, 1,000? Can you do the calculations? Can you look it up on the computer? Since I got you the computers, I bought you all computers for Christmas.
Down.
Is it down or up over the last week or two?
Down.
Down?
Yeah.
By how much?
Like 1,850.
I got it. Okay. Yours might be different. Okay. And then can you tell me what would cause the stock market to go down? Give me 2 reasons. Why? You guys are reading stock market articles every day now. You wake up like me, 4:30 in the morning. You're out of the house by 5. You're looking at your Bloomberg. Driving down the highway, looking at your Yahoo Finance. Right? Can you tell me?
Consumer expectations.
What?
Consumer expectations.
Are they falling or going up?
I don't know, I was just assuming they're falling.
What do you think?
Going down.
I'll take it. Falling consumer expectations. Anything else? You guys should all be just, data-hungry individuals on the computers looking for information. Now, that's not going to work in the corporate world. Okay, you got to be on your computer, on your laptop, on your cell phone. We're data junkies. We're looking for information. Okay, you got to be.
No, I was looking.
Were you awesome?
Yeah.
Did you find anything?
No, I was just on what's it called?
Trade. Got it. Trade war. Right. the Chinese decide not to tour Montana, right, and the market would fall, right? Because they're not gonna buy our stuff anymore. So there goes our exports in ag. Anything else? You need to write this down. 2 reasons why stock prices will go up and down. Future earnings growth expectations. Future earnings growth expectations. If they go down, the stock market goes down. If they go up, the stock market goes up. Okay, you need to write that down. The other is falling interest rates. Will cause the stock market to go up. Rising interest rates cause the stock market to go down. Okay. Where is oil prices today?
They went up.
What is it?
Didn't they go
That's
I was
okay.
talking
Now
about
you're
like
doing
the
good.
news, like.
You're fine. You're engaged in the process. That's exciting. It actually accelerates the process. So where's the barrel of oil right now? Traded. Click, 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 click. Click, 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 click. Okay, now we all live on our phones, so it's easy just to go straight to your phone and look this stuff up. Okay, click, 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 click. Click, 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 click. Okay, I like to hear a little pitter patter of keyboards clicking. So where's oil trading right now? Do we care? Yeah, because you're going to be investing in ETFs and mutual funds that will have basically oil company exposures in it. Maybe you go work for Chevron or something, or Valero.
$58.34.
Okay, $58. Is it up or down?
It's down.
Can you give me a delta in the last week or two? Didn't oil prices go right because the Saudis' production got blasted supposedly by the Iranians, or the Houthis, and what's it down? If they're down by how much? It came off its peak. Didn't it go as high as like 60 or 70 bucks? So it's down what, like almost $10 or something? All right, so basically 1/5. So what's that, like 12%, 10%, something like that? So down 10%. Maybe $10. If you can do some analysis and give me that stuff, that's kind of what I'm looking for. Is I'm testing to see if you're tracking the markets. And why is it down? We know why it went up. Why did it go down? What?
Foreign relation.
No. Why
Because the
demand?
prices went up.
What?
Because the prices went up.
Yeah, the price has been going down. Why? Is it increased supply, decreased supply, increased supply, or decreasing supply? Microeconomics. Decreasing supply or increasing supply? When prices go down, is it increased supply or decreasing supply? What is it? Okay, how does that work? Increasing supply makes prices go up. Go back to your microeconomics class.
Increasing supply makes prices go
Yeah, it's
down.
$58 a barrel.
Isn't increasing
So if the prices are going down, is the supply increase or decrease? Increases, got it. Okay, so increase supply. Got it. Didn't the president release some oil out of the strategic reserve? Yeah. Is there still frackers in this world?
I just have a question. What does it say underneath how much? Sorry.
10% or $10?
Oh, thank you.
Is what it went down. Okay. So the president released some supply. The frackers are still pumping out a lot of oil, and the global oil markets are still flush with a lot of oil. Okay. So it went up and then came down, back down again. Where's gold per ounce?
1,521.
What is it? 1,521 an ounce?
Yeah.
Right. Is it up or down?
Up
It's been
0.01%.
going up.
Just right now. Actually, it's went up 0.01.
It actually has been going up. It actually has been going up. I mean, when we were tracking it, I think last year was around 1,200. So let's just say it's up like $200 over the last year. Got it. Is oil a commodity? I mean, is gold a commodity?
Yeah.
Yep. Does it follow inflation? prices go up because people are scared of Syria, the Russians, the Middle East, the Iranians. So if there's geopolitical risk, higher geopolitical risk, do people go into gold?
Yes.
Yeah. Okay, so I would say higher geopolitical risk. And actually a lot of countries, or a lot of people buy gold when they think that their currencies are going to devalue. So devaluation of currencies, or depreciation. And a lot of currencies, the euro, the yen, the renminbi, or the yuan out of China, all of those currencies that have been actually devaluing and depreciating, and investors are going into gold to basically retain their purchasing power. They're scared. Okay, where's the 10-year Treasury yielding right now? What's the bond yielding right now? And then can you find the trend in the bond yield and tell me where it bottomed over the last 4 weeks and where it is now? Because it reached an all-time low and then it spiked. So a lot of people made a lot of money when the yields went down, because when interest rates go down, bond prices go up. And then the 10-year Treasury yield went up significantly over the last 2 weeks, so those people lost a lot of their money. So where's the 10-year Treasury yielding right now?
1.708,
1.708,
and it's down
and that's down for the day, isn't it?
for the week, for the five, I was just looking at 5 day.
Or go back like 2-3 weeks. Tell me where it was.
Since the 12th, it's been going down. Why is that?
How high did it get?
1.923.
1.9? So let's say 1.72, and it was from 1.9. So 1.9 to 1.7 to, what's that? So it was at 1.92%. It's now at 1.72%. So how many basis points is it? What was the change? What is it? 20?
Yeah, 20%.
Okay, so this is how you do it. The 10-year Treasury was yielding at 1.92%, or 192 basis points. I need to write that down. It was trading at 1.92%, or 192 basis points. Okay, basis points. Got it. And then it dropped to 1.72, or 172 basis points. So the difference is 20 basis points. So it fell 20 basis points. That's the terminology, okay, that you want to use. All right? So it's down. Using, what's the Fisher equation? Nominal interest rates equals what? What's the Fisher equation? You can click this, click this.
Real rate
The real rate
plus the inflation expectations.
plus inflation expectations. Got it. So the real rate doesn't move very much, only moves secularly or cyclically. So the majority of the movements in Treasury yields comes from where? Real rates don't move on a daily basis. They only move secularly or cyclically. So the majority of the moves in the 10-year Treasury yield comes from where? Inflation, say it louder.
The inflation expectations.
Inflation expectations. Got it. So if the 10-year Treasury yield dropped 20 basis points, what did inflation expectations do? Go up or down? Down by how much? 20 basis points. Got it. So lower inflation expectations. start talking about bond yields, the Fisher equation should like pop into your brain. So if yields are going up and down, inflation expectations are going up and down, okay? Positively related. So if inflation expectations are going down, what does that tell you about economic growth in the future? Is it gonna go up or down? Gonna go down, got it. And if the inflation expectations in the economy goes down a lot and stays down, what's that called? A recession. So if the 10-year treasury yield is dropping significantly down and fast, what does it tell you about economic growth in the future? We're going into a recession. And the yield curve looks like this right now. It looks like that. That's the yield curve. So this is like the 3 months, the 6 month, the 1 year, the 2 year, 3 year, 5 year, 10 year. So if these are the maturity of the bonds, right here, what does the yield curve tell you about inflation expectations and economic growth within the next 2 years? It's gonna go down. And what's that called?
Recession.
Yep. Okay, so the yield curve actually predicts this stuff. And it's the inflation expectations. It's tied to economic growth, okay, expectations. And that's why the yield curve is such a great predictor of the economy and where we're going, is because the bond market that determines the yield curve is massive. It's like $100 trillion. It's massive. It's huge. Okay, so where is the dollar to the pound and the dollar to the euro? Where's that trading? It's like a dollar. What is it? Where's it trading? Click, 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 right? Hello Siri, where is the dollar to the pound? or dollar to the euro?
$1 is 0.80 pounds.
Yeah, just flip it. Divided by 1.
Wait, what's a pound?
1 divided by 0.8 something.
1 divided.
Just flip it.
Oh.
It should be 1.2 something. What is it?
1.25?
1.25. Got it. And then what's the euro? It was trading at $1.10. 1.10. Is it? So has this gone anywhere up or down over the last few days? It's been pretty steady. And what about the pound? The pound's a basket case, right? Boris Johnson, crazy hairdo. Okay. Prime Minister wants to do a hard Brexit. Can you see some trend? Can you go and find the currencies and do some trending so you can kind of see? What do you think the dollar's done against the euro? You think it's appreciated or depreciated?
The dollar against the euro?
Yeah, I mean, what do you think the United States is doing compared to euro? Is Europe in a recession or growing fast, or where's Germany? Germany's economic growth rate is negative. Okay, so what does that tell you about the dollar to the euro exchange rate?
Depreciating.
Yeah, the euro's going to depreciate, the dollar's going to appreciate against the euro. So it's going to be cheaper for us to buy the euro.
Isn't that because of like Brexit too?
It has a little bit of there's a little decoupling because Brexit's kind of decoupled the pound from the euro, but they are correlated with each other. But Germany's in basically technically a recession, which would cause the euro to devalue, which means that we can buy more euros, right? So it's cheaper for us to buy so this is probably going to be 1.8 or 1.7. And then the Brexit, it's actually been like 1.2, it's now 1.5. So because of the Brexit negotiations and the delay, and actually it seems to be more stable, that actually the dollar is devalued against the pound, which costs us 5 cents more, basically buy a pound now than it was before. So overall, let's just say that the dollar, let's just say the dollar's appreciated, against the pound and the euro. So this would be down, right, because it's gonna cost us less, you know, per euro. We've appreciated, they've depreciated, so it's down. I'd say it's down, let's just say 2%. And then what would cause the dollar to appreciate and those foreign currencies to depreciate? Slow economic growth. And how about political instability? Those are just a couple factors. So I was just looking to see if you guys were tracking the markets. Do you know where the, I mean, you could be sitting around the table with your parents and your family and stuff, and it's like, oh, did you know the Dow, like, you know, dropped 200 points to 26,949? You know, they'd go, wow, that's amazing. I didn't know when you started, you know, tracking the stock market. Oh yeah, and the 10-year Treasury yield is now at 1.72. It's down 20 basis points from 1.92% over 3 weeks ago. So you sound pretty smart, don't you, when you start talking like that? Yeah. All right. Let's do the next one. Can I erase that? Did you want to take any pictures of this or anything? No? You got the notes? Okay, cool. All right. So that's what I'm looking for. What we're going to do now is we're going to do the supply-demand analysis. And this ties right into your memos. Okay? This ties right into the memos. So traders, economists, financial analysts, CEOs, CFOs, CIOs, chief marketing officers, chief investment officers, you know, they all went to business school. They know the economics, they know the finance, they know the accounting, they know the marketing, they know operations, they know legal, they know pretty much everything. Okay. Well, what's going through their brains is the supply-demand analysis, okay, particularly around these major asset classes. So what you're going to need to do on your exam, and this is how I would set it up, is I would start with the supply, and then I would go demand. This should bring back some nightmares for you in your microeconomics class. How many people like economics? Yeah, I love it too. Q supply, quantity demanded. What's this curve? What's that? Supply. Got it. And what's this? Demand. Got it. And this is how I set it up, just like this. Q star, D, Q star, supply. What's this point right here? Got it. And then this point right here. It's the market clearing price. This is price. Okay, and then what we're going to do is we're going to do 4 things. First we're going to shop the supply curves. Okay. And we're going to go like this. So if supply shifts back, what happens to quantity supplied? Shifts back. Got it. And if supply shifts back without any movement in demand, what happens to price? Got it. Okay. And then this one, when supply shifts out, what happens to quantity supplied? What happens to quantity supplied? Shifts out. Got it. Goes up. And then what happens to price? Goes down. Okay, so that's that. And then let's do this one. If demand shifts up, happens to quantity demanded?
Goes up.
Goes up. And what happens to price? Goes up. Got it. And then if quantity demanded falls, what happens to quantity demand? Goes down. And what happens to price?
Goes down.
Goes down. Okay, got it. Okay, so that's it. So now let's do stocks. I'll try to get through this as quickly as possible. And we'll do the 5 major asset classes. Okay. So, 2 things would cause the supply curve to shift back for stocks. One, buybacks. Stock buybacks. Apple's got billions of dollars in cash, they don't know what to do with it, so what they'll do is they'll basically take that $1 billion and buy back their stocks. That will cause the stock prices to go up. Okay. The other is reverse stock splits. This is a futile effort, this is not a material. It's technically correct, but it really doesn't have an influence. So the majority today that's causing stock prices to go up, particularly over the last 10 years, was basically all these companies raising all this money in the bond market at very low interest rates and basically using the money to buy back their stock. So through an accounting method, inflating the stock prices. Okay. And then what would cause the supply curves to shift out for stocks? I got 2. One would be,
What were the first 2 for?
hold on a second.
What were the first 2 for? Buybacks and the first 2?
Yeah, what I tried to do is I tried to do the color coordination,
So if it's
because I like color. So you know, the green goes with the green, the blue goes with the blue. And I'll go through color coordination so you can tie it right back. Okay. Do you want me to go over those again?
no, I got it.
Okay,
Yeah.
perfect. So the other would be initial public offerings, and then 2 would be seasoned. Or secondary offerings. So these companies like Apple and a lot of other companies, when the stock price is really high, what they'll do is they'll go to the SEC and say, I want to register some more shares with you so that I can issue them so I can get a bunch of money from issuing stocks at inflated stock prices. So we can take the money and invest it and build plant and equipment and hire a bunch of people and try to drive revenue growth. Okay, so those are basically the stuff that I came up with. Maybe when you do research on these articles, you'll find some others, but those are the main ones that I found. And then what would cause demand for stocks to go up and quantity demanded to increase and prices to go up? One would be higher earnings growth rate expectations. The market thinks that the economy is going to increase and companies are going to make more money. If they have more money, they grow more, they have more earnings. If they have more earnings, they pay more dividends. If they have more earnings, they can plow back the money and they can grow their companies faster. So higher earnings, growth rate expectations. 2, low falling interest rates. And then, how about not only low and falling interest rates, but low and falling inflation. That's another one too. employment. There's more economic growth, there's more employment, people have more money, they spend more money, they consume more, they invest more. Companies do the exact same thing. So overall higher economic and employment growth. And then there's another factor too. People, sell off their bonds and go into stocks. When they see the markets become more calm, less volatile and less risky. Okay. Lower geopolitical and economic risk. Okay, so those are the main factors. Now what you do is you just flip it. Okay. You just do the opposite. You just write the opposite. So it's going to be lower earnings, growth rate, expectations, high, about rising, higher interest rates, and inflation. Lower economic and employment growth. Got it. And the last one is going to be what? Higher geopolitical and economic risk. If you know one, then you know the other. Okay. I usually just flip it. Okay. So it makes it logical too when you're writing it out on the exam. So now let's do oil. Okay. Okay. So what would cause the supply curve to shift back? Well, and you guys can just yell out stuff if you want to. Instead of me doing all the talking, you can just yell out stuff. Anybody ever heard of OPEC? Yep. OPEC. OPEC production cuts. Okay, that would be oh, how about this one? Supply line disruptions. And I would even say not only supply line, but production. Terrorists, right? Houthis, Iranians bombing the Saudi production, disrupted it, stock prices spiked, and then somebody's been sending in drones into the Straits of Hormuz, going after the Saudi ships, and I think even after the British ships too, to disrupt the supply lines. Okay, so that's going to do that too. What would cause the supply curve to shift out? Well, OPEC, again, this is a cartel. This is an oligopoly. You basically collude and basically fix the prices based on the production ability to increase and decrease production. So OPEC production. Got it. What do we do here in the United States? What's our claim to fame in regards to oil production? What's it called? The boys in Texas love to do this stuff. And they don't care about the environment either when they do it. It's called fracking. Got it. looking for other technologies. Okay, got it. And then what would cause the demand curve for oil to go up? Come on, you can figure it out. Maybe some of the factors in these other ones may actually be the factors that would drive demand for oil up too. You think? Maybe? You got any that you can think of? That you would want to take from over here and put it over here? Anybody? Anybody? You can always just read the top, one of the top four, and you're probably gonna, you know, you have like a 25% probability of being right. What?
Economic growth.
Got it. Oh, perfect. Yeah. Higher global economic. Got it. Anything else? Economic growth. What else? What else? EMP, let me spell it out for you. Employment, got it. How many people do we have on the planet now? What? How many billions do we have on the planet now? Do you think increased population growth would have an impact on global demand for oil? How about when you send in the tanks, you know, into, you know, Eastern Europe, you know, from Russia into the Crimea, what are they driving? Volkswagen buses with the peace sign on it? Now, what are they driving? Jeeps, tanks, trucks. What do they run on? Gas. Some more. Got it. Can you think of anything else that would increase the demand curve for oil? Economic activity. I mean, all of this stuff is petroleum based. You know, so everything you wear, anything that's nylon, it's all petroleum based. So we'll just use those. And then what would cause the demand curve for oil to go down?
Technological advances.
Yeah, totally. Yeah. Can you give me an example?
Tesla.
Yeah. Electric cars. Alternative renewable energy. I mean, they were protesting out in front of the United Nations today. What's her name? Greta. A young activist from, I think her name from Sweden or something like that. She was screaming at him. What else would cause the demand curve to go down?
Lower economic growth.
Yeah, exactly. Lower economic growth, population, employment. I'll leave it there, but I'll let you guys add some more. Okay, you can take some from the other side. And then what about gold? Gold is a tough one. Can I stand right there? Can I stand right there?
Yeah, sure.
Thank you. Gold's a tough one. I came up with Treasury Central Bank hoarding by central banks. The banks want to buy these huge amounts of gold and stick them in vaults to be able to build up basically the ability to sell those off at some point in time if they need to come up with dollar foreign currency reserves to pay off some of their liabilities. and they like to hold a lot of gold to anchor their currency so it doesn't devalue or depreciate too rapidly due to inflation. So it's kind of a hedge. Okay. I can't think of too many other things. That should be green. What would cause the supply curve to shift out? Can you think of anything? So selling off by the banks, it's going to inject supply into the market. What else would increase supply? What if I come up with a binocular that allows me to look into the ground and find gold, and then a magic, drill bit, where we can drill into the ground and pull up oil. I mean, the gold's a lot easier. Would that increase the supply of gold? So technological advancements. That's all I can think of. Maybe you'll come up with something. Okay. And then what would increase the demand for gold? When inflation goes up, what happens to the purchasing power of your currency? Does it? So higher inflation, depreciation, devaluation of the currency. How about geopolitical risk? When people are scared, are they going to go into stocks? No. They're going to buy gold and bonds. Okay, so higher geopolitical risk. What else would cause demand for gold?
Good security.
Yeah, it's a store of value. People are trying to retain their store of value. What would cause the demand for gold to go down? Can you just turn it around?
Lower inflation.
So it's going to be lower inflation, appreciation, revaluation of currency, and then what's happening to geopolitical risk? What's happening to geopolitical risk? Falling. So those are just some of the ones that I came up with. And you might find some others as you're doing the research.
Take a picture of that.
Hmm?
Take a picture.
Yeah, go for it. So what's the next one? What are we doing now?
Bonds, right?
Yeah, we're doing bonds. Okay, this is a fun one too. Is this one? So what would cause the supply curve to shift back for bonds? One would be, let's see, the Fed buys bonds from you, right? They're gonna buy bonds, right? So I'm gonna get the bonds, taking bonds out of the market. I'm gonna give you cash. It's gonna drive up bond prices and drive down interest rates. So how about Fed purchase? Bonds. And when they do that, that's called open market operations. Got it. And when the price of bonds go up, interest rates go down. Got it. What else would cause, oh, I got another one, two. Maturing bonds. So as bonds reach their maturity and if they're not replaced, the supply curve shifts back. And then the other one, which is one of my favorite, budget surpluses. Right? Because we're not running a deficit, we're not issuing bonds to plug the gap. So if you have the surpluses, we can actually buy back the bonds and it can expire the debt outstanding. So we can actually do a buyback. This actually happened under Greenspan under the Clinton administration because it was the only time in the last, I don't know, 40 years that we actually ran a budget surplus. Okay. So let's turn it around. What would cause the supply curve to shift out? So you tell me.
Let's sell bonds.
Yep. Good. Selling bonds, next.
Budget deficit.
Yep. And what else? How about extending? Bond maturity. Stephen Mnuchin, who's the Treasury Secretary, wants to issue 50-year bonds. Most of the bonds out there are like 10 years, there's some 20 and 30, but he wants to do 50.
Just to clarify, under gold, does it say treasury and central banks?
Hoarding.
Hoarding?
Hoarding,
Hoarding.
where they hoard the gold.
Gotcha. Thank you.
So basically, they're taking it out of the market and they're keeping it. They're sitting on it. Okay? So what would cause demand for bonds to go up? Low, falling interest rates and inflation. Using the Fisher equation, when inflation expectations go down, interest rates go down. Got it. And when interest rates go down, bond prices go
Yeah.
up. Got it. And would you want to buy bonds when interest rates are falling?
Yes.
Because you're making money. Got it. Okay. What else would increase demand for bonds? How about higher? Interest rates. So we're paying 1.8% on the 10-year, and the Germans are paying negative 0.5 on their 10-year bonds. Is there going to be more demand for our bonds or more demand for their bonds? Theirs is negative, ours is positive. Ours. Okay. Also, liquidity preference. Are US government bonds highly liquid? Yes, they are. Because they can always raise taxes and print more money, you know, to pay the coupon or the principal at the end, so they're highly liquid. So liquidity preference, also safety. Right, these bonds are risk-free. So when people are freaking out, they sell the stocks and they go into bonds. They sell stocks, go into gold, okay? Because they're scared. What else would cause demand for interest rates to go up? I think that's it. And I wouldn't say higher, I would just say high interest rates. Okay. Let's do, what would cause demand for bonds to go down? Just read it off to me.
High interest rates?
So it would be high, or would be rising. Rising interest rates and inflation. Got it. What else? Yeah, I like that one. Low, negative interest rates. All the former Fed chair women and men are saying we're going to get used to negative interest rates, which is horrible. It would just crush people. And then the last one. Less liquidity preference. And they feel they want to go back into the stock market, so they're willing to take on more risk. Okay. So those are all I got for now. It's still a lot. It kind of gives you the factors. These are the factors that in your memo that you would write. Okay. And different factors at different time periods are going to influence the prices of these asset classes. Either it's going to come from the supply side or it's going to come from the demand side. The question is which one's driving the markets currently, okay, and over the long run. And then the last one is going to be US dollar and foreign currency. And that's the terminology is FX. So what would cause the supply curve for dollars to shift back? Well, if the Fed is selling you bonds, right, and you're giving them cash, right? We're pulling money out of the market, aren't we? So that's what else would cause the dollar to shift? I actually think it's inflation. Right? So as inflation increases, your dollar's purchasing power actually shrinks, right? Is that right? Because that would cause the value of the dollar to go up. I don't know if that's going to work. Let's just say lower inflation. Okay. What would cause the supply curve for dollars to shift out? Fed buying bonds. Right, so when the Fed buys the bonds, it's injecting cash into the economy. Okay. Two. I don't know if this doesn't work for me. For some reason. How about Fed printing dollars, increasing the money supply? Oh, how about this one? Sell off by foreign investors. Do foreign investors dump our dollars sometimes? We do. Okay, okay, what would increase the demand for the dollar? Anybody have any ideas? What would cause the dollar to appreciate? Why would people be coming in, dumping their foreign currency and coming into the US and converting from foreign currency into the dollar? Why would they do that?
Cause it's cheaper.
Yeah, you got it. Geopolitical risk, foreign. Right, the world's a dangerous place and everybody wants to be here. What did you say, cheaper? How about low? How about low inflation rates? Compared to Venezuela, 1,000,000%, US, 10%, which one do you want? 1,000,000 or 10%? How about this one too? Higher interest rates? And higher expected returns on stock and real estate. Foreigners buy our real estate?
Yes,
Do they buy our stocks?
yes.
Do they dump their real estate in stocks and buy our real estate in stocks if they think they're gonna get a higher rate of return?
Yes.
Absolutely. Okay, and then the last one, I would just flip it, right? One. Be- This is geopolitical risk, this is higher foreign geopolitical risk. So this one's gonna be, political risk, foreign, lower. Oh, I forgot another one up here. Number 5 is higher labor productivity or corporate profit margins. Okay, that could be one. Okay, and then 2, inflation. 3, well, interest rates. 4, low return expectations. Stocks, real estate. And the last one is low labor activity and corporate profits. Whew, that's exhausting. So when you're writing your memos, these are the factors you want to be thinking about. Okay, and then think about how it shifts the supply curve, either back or out or demand curve up or down. And then you'll be able to forecast, where you think the prices of these major asset classes are going. Now remember, when you're talking about US dollar, you're not talking about prices, you're talking about value. So this is the value. The value of the US dollar. All the other ones are prices. How much time do I have?
22 minutes.
Okay, perfect. And then we'll do this next one here. So you want to take pictures of this, and I'll walk you through this in the next 20 minutes. So you want to take pictures. cover after taking economics last year.
Yeah, I did think that, yeah.
Economics is in everything. Okay, tell me when you guys are ready. And we'll slam this out. We should be able to finish, the rest of the exam on Thursday. And then I'll also do a study session for you too.
Oh, it's me. Oh, it's me.
I just airdropped all these.
Okay, so tell me when you're ready. Okay, you guys ready? And it goes this way. Okay. All right, so this lecture, everybody thinks finance is, okay, accounting, or I'm gonna do financial analysis or something like that. That's basically, yeah, you're gonna do it, but that's dead. Okay, what's happening now is that finance is a technology, enabled by technology companies. So finance has always been a tool, it's always been extremely innovative. The market and individuals like yourself and large institutions have always gone to Wall Street and asked Wall Street to invent product to solve their problems. Okay, so the question really is, what creates an environment of product innovation within companies? Apple's a very creative company, so is Salesforce. There's a lot of really creative companies out there. These top banks, Goldman Sachs, JP Morgan, Wells Fargo, B of A, US Bank, all of the hedge funds, private equity, public equity firms, investment banking firms, trading firms, they're all extremely innovative companies, constantly looking to develop new processes or new products to be able to sell in the marketplace or take advantage of themselves. So let's just quickly go through like a capstone. This is basically your capstone. Okay. So you're getting it now in your junior year, you're going to get it again in the last semester of right before you graduate. But this is basically it. So over the years, I've noticed and I've worked for some extremely innovative companies that have developed financial products. Okay. And the criteria for product innovation is consistent across tech companies and across finance companies. It's the same thing. All of these companies are constantly scanning the marketplace, looking for market opportunities, and then if they see an opportunity, boom, they're all over it, they jump all over it. They do the research, they design the product, and they try to bring the product to market as fast as possible to capture market share and generate revenue. Okay. So constant, ongoing environmental scan is for one, and two, they're willing to change their business models and change the structure of their companies based on market changes, increased competition, or regulatory changes due to regulatory changes. And the finance industry is extremely regulated. I mean, there was the Glass-Steagall Act that basically separated investment banks, Rand-Leach that basically deregulated the market, and Dodd-Frank that basically re-regulated the market after the 2008-9 financial crisis. And those deregulation, regulation caused those big companies to restructure and change the way they do their business. You also have to understand industrial and individual psychology within the firm. Basically, these buildings in which you go work in are just basically manufacturing plants. There's no difference, in my view, of a plant that manufactures a product in an industrial building and one that basically manufactures services within a silo or in an office building. It's the same industrial psychology, it's the same individual psychology, it's the same group psychology that you, as the manager, has to understand to be able to innovate and to create environments of creativity. Organizational change and the focus on change management. Very creative companies that create products very quickly and are responsive to the market use change management. It's an internal philosophy or ideology within the firm. And the companies are willing to restructure the organizational structure of the company very rapidly if they have to realign with the marketplace, or to basically defend themselves against intense competition that's stealing their market share and their revenues, because it's a fight for survival. I mean, capitalism is brutal. You also need cultural leadership. You need models within the company, leaders that are going to exude charismatic, charisma so that people will follow them, people will emulate them, people will model them, people will behave like them through the process of self-efficacy so that everybody within the company has basically bought into this culture of innovation and creativity. So it's really cultural leadership. That's also a prerequisite. And then there needs to be communicated clear strategy, tactics, and operational plans with clearly defined metrics, achievable metrics, that everybody understands and everybody is striving for. So you need clear communications. Then once you set that up, you can move right into the production and the process innovation stage. The process and the product innovation stage is basically monitored within these large corporations by using technologies such as ERP systems, enterprise resource planning systems. So basically over time, it's a knowledge base where you're basically recording the development of all these products and processes so that when the market changes, you know exactly what you need to do, you reassemble the team, you pull out all of the information from the knowledge base, and you basically design the product and execute it and bring it to market because you've already done it before. You're not building it from scratch. So these systems allocate resources but also pull in the knowledge from prior products and processes that the company has developed in the past. You have to be able to, when you're developing these products and processes, you got to recognize the needs and the wants of the market. You got to listen to your clients. And if the clients want something, then you got to respond. You got to build the products with the attributes that they want. There's got to be an ongoing product development process within the company. There's got to be a research and development arm. That's what you, as marketing and financial engineers, are doing. You're constantly building product and processes to meet the market's needs on an ongoing basis. Because if you can't, you're not going to generate revenue growth, and the market's going to discount you and discount your stock price in the process. You got to design these products and processes with the attributes that actually solve the problem. When I got into the business in 2010, the financial crisis had just occurred in 2008 and 2009. The clients were freaking out, saying we need guaranteed products. We want to buy guaranteed financial products where we don't lose any money and we never run out of money. And New York Life, which is a 167-year-old financial institution, developed 2 guaranteed products in less than 9 months and was able to go in and capture 50 to 60% of the guaranteed annuity market in 9 months. And to this day, they continue to capture 40% of the market. It's a perfect example of the ability to execute. Product production, manufacturing, and distribution. Once you've figured out the product and standardized it, you can now distribute it through either your existing distribution networks, and if you don't have it, you either got to buy it or you got to build it. So you're going to have to go through the capital budgeting process, which we'll walk through later on in the second part of the class, where how do you decide on making investment decisions? How do you decide to do this project or this product or not? If it costs too much, we're not going to do it. If it doesn't pay out long enough in the future, we're not going to do it. If we don't reach break even very quickly, we're not going to do it. So there's metrics to do it. You got to figure out the channel distribution, different types of channels to distribute products, to the marketplace. You got to figure out the networks, and you got to figure out the mix across your distribution channel, and you need to optimize it. Okay. The next, you got to do the same thing with your supplier chain networks. Okay. Optimize the networks. You got to figure out who the inputs are. If you don't have the inputs, you put into the process, and then manufacture the product or process, and then distribute it through your distribution channels or affiliated distribution channels to maximize revenue. The next is business development, marketing, and sales. Okay, this is the goal of this lecture, because I was told by a bunch of people that you guys don't know the sales cycle. You don't understand sales. You don't write very good memos, and you don't understand the sales cycle. So that's why we're doing this. Okay. So the first is business development, marketing, and sales. You got to have a marketing research department that basically is identifying the segmentation, how the markets segment, okay, and how they are stratified. You can then, from that market research and the stratification and the market segmentation analysis, identify your target markets, and then figure out what you're going to sell into those target markets and sell into them. It can be based on psychographics. I mean, I'm a baby boomer, you're going to be selling me a different product than a hipster, millennial, right? So it's based on psychographics. Demographics, you're gonna be selling different products to people in their 70s and 80s than you are gonna be selling to people in their 20s and 30s. Okay? The question is, do you understand what the segmentation is? How do you design the products and the processes for those different segments and sell into those marketplaces? And then business segments too. Am I gonna sell into enterprise level to large companies, or I'm going for mid-cap or small-cap companies? Am I working with startup companies? Who am I selling these financial services and these financial products into? The next is, after you've done all of this, then you have to do the marketing campaigns. You have to start advertising to generate prospects, to come to the company, to sell them the products, to generate the fees, to generate the revenues, to generate the money so that the company can be profitable. So we're gonna make, in the financial services industry, we're gonna make fees. We're gonna make fees on assets under management, or what are called AUM, okay? We're also gonna make commissions on selling these financial products to different types of consumers. Client prospecting, me as the salesperson, constantly prospecting for new clients. I'm either using the advertising techniques to basically drive prospects to me, or I'm going out and finding the prospects through my own advertising and marketing campaigns and channels. Once I get a client sold, once I sell them something, I got them locked in. Most clients are gonna buy from you again if they bought from you once before. That's how Microsoft did it with, Microsoft 7, 8, 9, 10, Apple phones, X, Y, Z. It's the same thing. Once you've got the clients locked in, you can sell other stuff. Not only the same product, that's been improved, but you can cross-sell them other products, or you can upsell them to a higher priced product. So the key to the prospecting is really creating the lock-in, where you lock them in and you're creating recurring income. And you are focusing on conversion rates. I send out X amount of emails, I get X number of calls, I meet with the client, I lay out the plan, I meet with them again, I close them, I do it again. Okay, so the ability to increase the velocity in the conversion rates is extremely important. And you want to accelerate the sales cycle. And you want to scale up the sales. Because there's no difference for me in writing 10 $1 million life insurance policies as opposed to writing 10 $10 million life insurance policies. So if I can scale up to an enterprise level in my sales cycle and increase the velocity in my conversion cycle, we're talking about some serious money. We're talking about being extremely successful. And then the next is really customer feedback. There's a customer feedback loop, where once you go into client services and you're tracking your clients through a customer relationship management system and monitoring them, they're going to tell you what product attributes they want, what was working, what wasn't working, and it goes all the way back here and feeds back into the product process, innovation process, and all over again. There's two models. How am I doing on time?
Yeah, 8 minutes.
Perfect. I might be able to do it in 8 minutes. And then I'll go over this again with you guys later too. So there's two models, all right? There's two models that drive revenue in companies. There's developing technology and developing product, okay? So successful tech companies, which is finance companies, use the S-curve analysis. This is your operations research. So you have basically time here, and you have technologies. If you go back and you look at the great technology companies, they were able to develop and introduce new technologies consistently and contiguously over time. And once they set out a track record of developing successful technologies over time, the marketplace assumed that they would be able to do that forever into the future. And if you use the Gordon growth model to basically value the enterprise level, the value of the company, it's basically future cash flows into infinity, divided by the expected return on the company minus the growth rate in the future cash flows. So if companies can do this, the market will assume that the cash flows are going to grow at a maximum rate forever into the future, which will maximize the value of the company. So if you look at a lot of these companies, Tesla, Uber, these these unicorn companies that have come public and are worth billions of dollars in market cap, that's what the market is seeing. These are technology companies that can develop new technologies over and over again. The second model that's used by the marketplace is the product adoption cycle. This comes from the marketing literature. So every product that's introduced into the marketplace goes through multiple stages of adoption. The first is the innovator stage. You're burning a ton of cash, you're running out of money, all of a sudden you use social media and other types of scaling techniques to adopt your product, and all of a sudden it goes into the hockey stick phase, where basically your revenues, your costs, your profits, everything is scaling at an accelerated rate. Then everybody pretty much who wants to buy the product buys the product, and you move into majority phase. And then you move into late majority and then laggard. So the goal is to be able to introduce these financial products over and over and over again and create new adoption curves, creating the revenue growth path like you did over here, maximizing the expected growth rates in the cash flows forever, and maximizing the value of the firm. When you're introducing and developing new products and bringing them to market, you got to conduct feasibility analysis, which is also called capital budgeting in your book. Okay, so it's going to cost me X to develop the product. What are the expected cash flows in the future? Am I going to get a net present value? What's the future cash flows, the present value of the future cash flows, minus the cost? Is it positive? If it's positive, we do it. If I can break even on the product in maybe 1 to 3 years, we're going to do it. So we're using basically financial metrics to be able to make financial decision making. And then lastly, these companies, the leaders within the company and the talent within the company knows exactly when to enter the market to develop the product and bring it to market, and they know when to exit. So when they exit, do we keep the company? You know, do we keep the product line within the company because it's adding more value to the parent's enterprise value? Or do we spin off the company as a standalone through an initial public offering, and the company is worth more as a standalone publicly traded company as a company inherent internal to the company? When you spin them out, that's called a capital event. When you sell off that product line to another company, could be a competitor, that's a private placement. So the question is you gotta know when to enter, you gotta know when to exit. It's gotta be rules-based, not gut feel. You have to have a standard set of rules that says, okay, check, 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 we're entering the market. Check, 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 we're exiting the market. There has to be clearly defined metrics and benchmarks to benchmark it, to make those decisions. And lastly, the people within the firm are usually really good at what they do. They know that the decisions that they're making are correct, and they act decisively in their execution and execute on the opportunity. So that's it. How much time do we have?